Let's welcome Sindhu Sameer, co-head for equity sales at Emkay Global Financial Services, joins us on the show. Sindhu, good having you. Thanks so much for joining in. You know, at some point of time in the next 10-15 minutes, would want your thoughts on the big AGM as well. But let's first start off with what's happening in and around our markets. Results so far, we just did a piece in the morning. For our markets to clock in double digits, it almost seems to be a Herculean task with 57% of the weightage out till now, and the ask for the remaining 43% being much higher than what they are expected to do. Would it be a big disappointment if we do about 9% instead of 10%?
In terms of earnings? No, it will not be a big disappointment because the penciling in of earnings growth is somewhere in the range of 12 to 15%. But I think the jury is still not out. I mean, there are other quarters left. We can see some good numbers coming in other quarters also. But then coming to a point, if you are invested in a certain set of stocks, you better be concentrated, watch your nest egg on that rather than looking at broader numbers. But yes, 9%, I do agree with you. At the start of the year, it was somewhere around 12 to 15%. There were outliers who were saying that this can be a 18% kind of a year. It is definitely not there, but I think these are early days.
Well, Sindhu Sameer is already quoting what Buffett and Munger said, and we'll talk about that as well. But you know, just finishing off some of the details first. Sindhu, the last few days, the behavior between mid-cap IT and large-cap IT has been chalk and cheese. Now, I don't know what your call was 6 months ago, but hypothetically, if you gave your clients a call to go and log in big time into mid-cap IT, did you expect such a run-up? And now that it has happened and the valuations that these companies are trading at, would you recommend a switch from mid-cap IT to large-cap IT, or is it prudent to keep on with the mid-cap IT space looking at the numbers that they're given?
I mean, there is no binary operating out here that one needs to necessarily switch from mid-cap to large caps. You can have a very healthy mix of both.
Okay.
We have seen the numbers. That numbers have been by and large good and bad in both the spaces. It's not that mid-cap IT has not disappointed. Some companies have disappointed.
Yeah, Nucleus, for example, or some others.
I will not name names.
Okay.
I cannot take names. But it's a healthy mix. There have to be, one has to take exposure to mid-cap IT. There has been a smart performance coming from large cap IT. So it's a mix of both. I think it's too early to take a binary. The time to take a binary was 1.5 or 2 years back, when it was decidedly clear that mid-cap IT was offering far better growth and value mix than what large cap IT. It has played out and it has rewarded, I think, disproportionately for mid-cap IT now.
You mentioned that you could expect some bit of surprises from some quarters when it comes to earnings growth. Not all companies are out with the numbers. Is there any specific sector that you're watching for in terms of earnings?
See, the point is that good companies are performing. Look at the numbers which have come till now. It's not that a sector has been bombed out or a sector is having massive tailwinds. It is that the good companies for last 2 or 3 years have been managing their businesses well and has been showing the growth. Of course, there are certain sectors which are facing the heat, but by and large, good companies have actually differentiated. Now, it might just look at classic Buffett speak kind of a thing, but that's the reality. All one has to do is to look into with a fine-tooth comb that good companies are already doing well. Take the case of IT also. There are certain companies in large cap IT also who have done very well and have been rewarded well. And especially in case of other companies also which have been facing sector tailwinds have not been able to do well. So it comes all to good companies, great managements. That's the kind of response I'll choose to give.
Well, looks like you've heard this speech pretty closely from Mr. Warren Buffett. He also mentioned he's putting his money in capital-intensive sectors and not capital-light because of the valuation gap that persists. Are you also following that in India?
No, it's very difficult. What Mr. Buffett, and I'm no authority on him, is saying that the size he's commanding today.
Right.
Ideally, he would like to choose branded companies with capital-light models, with asset-light models. But the size he's sitting on today, those choices are few and far between. That's why he's going for a second best choice of capital-heavy businesses, but with a moat. So at some level, he is actually calling that, that America today does not offer that kind of investment opportunities which are to his taste and liking.
Right. So he's betting on roads and utilities. What is your view on these two sectors in India?
So these sectors are good and great, definitely. They have a moat. but definitely they are not capital light models. You will never find a great brand in these sectors. But in terms of sheer moat, and if you only have to construct one sector portfolio, then okay, you can just straight away get into capital light. But if you have to spread it across, then these sectors definitely will fit in.
You know, the other interesting bit that came out in the AGM, which I didn't highlight, of course, but when the conversation shifted to what's happening with the healthcare JV, there was a question that was expected and was asked, and he mentioned that they are trying to attack the moat that the pharma companies have, and it's a very strong moat. And you know, consequently in the conversation, Munger spoke about how the healthcare costs in the US are sky high and they need to get rationalized. Do you see this as an opportunity for the beleaguered global pharma generic names? US healthcare costs are high. It's been known for a while. The last 2 or 3 years, they've been in a bit of a limbo because of US FDA issues and otherwise. Our valuations and the fact that at some point of time, the government out there will try and figure out how to reduce the healthcare costs for the US aging population as well. Is that an opportunity for Indian pharma?
See, the opportunity for Indian pharma, I don't know why we have focused that only Indian pharma's opportunity is America.
But
of course, it's a big opportunity in US. And Indian pharma for last 20 years, right from 93, 94, has happily capitalized it.
Right.
So there are companies which are sitting on 50 ANDAs, 100 ANDAs, and 200 ANDAs. The point is this, that the opportunity for Indian pharma is twin-pronged. It's two-pronged. It's both India and America. But yes, if America does something, it's a 14 trillion economy, and it is spending a disproportionate share of its market, of its GDP on pharma. That opportunity is thrown open for everyone. Indian pharma has always focused on America, so we are the front runners. We will be at the vanguard of it. But repeatedly, there is very little out in the open that what kind of a disintermediation, what kind of innovation, or what will happen in American pharma space. So we don't have clue. In fact, he himself was alluding that we don't have much of a clue there, what's happening.
Yeah, well, and the constant alluding to don't look at short-term things like the trade wars and other things. So over the long term, you buy good companies and it'll hold true. I think something that Sindhu Sameer was alluding to earlier. One thing that stood out for you in the AGM? See, it's difficult to choose one thing in a fire AGM, but still.
I have chosen is the humility of the man, that he wants to be remembered as a teacher. Now, if you want to be remembered as a teacher, that too when you are one of the finest investors humanity has ever seen, talks about the philanthropy of a man, not in terms of giving real money, but in terms of sharing your knowledge. So that stands out. I think that was the hallmark of it. It was the most humbling kind of a insight, that you want to be remembered as a teacher. So that was a standout thing. And the way he has created a cult of value investing, the number of people attending the meet out there, and how many people actually have lifted out themselves of a relative poverty. The word is relative in America. It's and actually created a life-altering wealth for themselves, simply focusing on his investing principles. Those principles are timeless. He demystifies investing, and anybody can choose and apply those principles, whichever geography. The only thing is that it should be a capitalist geography, and you can really lift yourself out of whatever level of economic prosperity or lack of it you are facing.
Interesting. I thought there was one small lesson. I don't know if it really applies to India or Indian banks or no, but when talked about Wells Fargo, he did mention that, I mean, they kind of mentioned that what doesn't break you will make you stronger. And this episode will only help companies like Wells Fargo emerge stronger. Just wondering, Sindhu Sameer, if you would apply the same rule to banks in India. The companies have been virtually, at least on the reputation front compared to the other banks, been taken to the cleaners. Does this kind of lay a bit of a floor to what could happen or what could go wrong at those places, and would the future only emerge stronger for these banks?
So I think Wells Fargo was an archetypical example, and let's limit it to Wells Fargo. So inspiration from there to Indian banks or learnings from there to Indian banks are not that clear. Indian banks, if you focus on the private sector banks, are one of the kind of returns which will in fact make even Mr. Buffett salivate, especially in the private sector space. In case of Wells Fargo, what he is actually depicting is that how much of a long-term investing needs commitment. So you don't change the horses when the war is still on. Here the time span of the war is getting prolonged. That's what he is saying.
Interesting. Okay. Navneet, anything else? I mean,
lots to learn from him, and the way he acknowledged how he could not read the success of Jeff Bezos in terms of how Amazon has done so well in the last few years. And I think he's only missed out on one sector, but I think he's gained everything by buying more shares of Apple. That's the IT space. In the past, he's maintained that because I don't understand that sector so well, hence I'm not going to put my money. But I think the way he's been increasing his shareholding in Apple, that's reaping him very, very good returns.
And the idea is that investing, that's what he has repeatedly pointed out, and particularly in question number 56. There he points out that despite missing Google, despite missing Amazon, you can still create such a massive positive impact on your net worth, be it an institutional fund manager or an individual fund manager. So the point is that this is one game. Even if you miss the biggest gainers, you still end up quadrupling. I don't know how much, sorry, that's the wrong word.
Yeah.
How many multiple times you can multiply. And the first thing which he opened is that if you had put in $10,000 in 1942, what will be the worth now, and what if you had put in gold? So these are simple learnings. And coming back to his classic book, Intelligent Investor, and every time he does it, and this time, I mean, this is for the benefit of everyone who's watching this program, is that the best thing one has to remember is that you're buying a share of a business. You're not buying a stock tick.
True.
So that is, and the principles are timeless. He demystifies the art and craft of investing. That is what one needs to, and particularly he says you need not to be a rocket scientist of accounting to invest. One needs to have an attitude, just that.